Good morning, everybody, and welcome to the Toolkit. I'm Dirk Webb, the President and CEO of the St. Cloud Chamber of Commerce. The Toolkit is an ongoing business education series that we do usually virtually every month. And for today, April 17th, 2026, we're pleased to have Justin Smith of the Money Millstones Company to talk about how money works. We'll get to Justin in just a second. But we want to thank our sponsors for the Toolkit series: the City of St. Cloud, Osceola County, Orlando Health St. Cloud Hospital, OUC, the reliable one, the Osceola County Realtors, and Toho Water Authority. We invite you to make the Toolkit part of your monthly business calendar. All right, so money. We often think that money's a very simple concept, right? You try to bring in more than you spend. Well, I had the opportunity to read the book that Justin has called How Money Works. And after decades of running nonprofits, I still found this book to be an enjoyable read as it breaks down in very simple terms the concepts about money that we take for granted. So Justin is a recent member of the chamber the last few months, I believe, and we're so excited to have him here. And Justin, I'm going to turn you loose and let you fly with this.
Thank you, Dirk. I really appreciate that. I get to share my screen. Please let me know if you all can see it. Is it coming through for you all?
Here it is. Yeah.
All right, perfect. So thank you for that introduction. So I am Justin Smith. I am a financial educator with WealthWave, based here in St. Cloud, Florida. I'll just tell you a little bit about me quickly. I'm a Floridian by birth, originally from Jacksonville, Florida. Came to Central Florida about 14 years ago. Prior to being in the financial service industry, I was in healthcare technology for almost 3 decades. Um, but in the meantime, I also started doing financial services. And how I got started was really going on my own journey. I felt that I still had some gaps in knowledge myself. And whenever I looked, I just couldn't find who could fill it in. I felt like I kept getting little tidbits, just little bits of information, but not getting a complete picture. Well, as I went on that journey, I found a wealth wave and was able to get even more education. I had been pretty blessed and to say grateful to have made pretty good income, had done some things what I would consider maybe the right way, but this allowed me to even do better for my own personal self. So I got to wondering, well, how can I do this for other people? Because none of this was ever taught to us in school. Most of us know we got really the basic of the basic in school, and that really does not translate well into the real world. In addition to that, I'm the current chair of the American Lung Association in Central Florida. I also am a tobacco cessation facilitator for Tobacco Free Florida, try to help people stop smoking and vaping. So financial education, along with those other things, really works well and taking a holistic approach to individuals, businesses, and family about their overall wellness. And I cannot go without saying that I'm a husband, I'm a father, I'm a brother, a son, and an uncle, and all those things. So I really appreciate my family's support. Go ahead and get started. All right. So who is WealthWave? You might say, well, Justin, okay, I hear you say WealthWave. What do you actually do? So I'm a licensed agent here in the state of Florida, also in Georgia and Louisiana. I work with a team of individuals that are completely certified fiduciary folks in the financial industry. And with through them and through my own education, we're able to put strategies in place and educate people on the different financial products out there. Currently, we've been seeing over 500 plus media features. We are also have over 1 million books, either by print or by ebook, that's out there. You can see us over almost any platform you can think of, from TV to podcasts and everything in between. And so we really like to try to keep the movement going and have conversations with like our local chambers and other community events to get people in a better financial situation. Now, the way that we do that, that is through our Money Book series. As you can see, we have 4 books in that series. The book that I gave to Dirk was actually the first book that was released, which is the How Money Works, Stop Being a Sucker book. The Change Your Literacy, Change Your Life book to your left, that is our ebook only. So if you scan any one of those QR at the bottom, you can actually request an electronic copy of each book at no cost to you. You can also request a physical book, and if you're here local, I'm happy to hand deliver it to you or put it in the mail, whatever you prefer. I personally have gone through these books many times just because I enjoy reading them. I've also given them to clients that's given really great feedback over the years that I've been in the business as well. Now, let's kind of dive into this a little bit and kind of talk about what we see in our communities and what we're seeing in the world. Now, this study was actually done a little more than a few years ago now, but it's still really important. So even back when this survey was done, it talks about that it found that from a financial literacy standpoint, only 30% of people in the world are financially illiterate. Now, that's a problem. We have billions and billions upon billions of people in the world, and we understand that it's different cultures and different viewpoints when it comes to money. But with that being said, 30% is not enough. And where do the people that don't have the education, who do they look for? Who can they partner with to get what they need? And that's where we come into play. Now, one of the things that we should be thinking about as well with all of the other things we got going on, how much does financial illiteracy cost you and your family? You know, when you're not understanding how money works, you end up potentially paying higher premiums for your insurance. You may be using a credit card to cover emergency expense because you don't have a emergency fund set up. You could be paying higher interest on debts because it could be things that you have on your credit that may be causing you to have a lower score. Therefore, you're paying higher interest on credit cards, auto loans, home loans. Are you living paycheck to paycheck? In my young life, I can say I was one of those people that lived paycheck to paycheck. I didn't really understand the importance of saving money and then where to save it as well. But I was able to get around some mentors and some friends that truly had my best interests, and I was able to come out of that in a young age as well. Now, are you setting aside money for retirement and long-term care? I can tell you, I've talked to many family and friends and clients that when you get to asking this question, a lot say, I just don't have the money to put aside right now. Usually my rebuttal back is, but you have enough to buy coffee every day. Now, I'm not attacking coffee lovers. I like my coffee too. However, you got to think about your priorities. And we also know that most of us have been in a situation where we had to take care of a loved one in some type of long-term care situation. And it's something to think about as you're getting older. Will you need something like that? Now, I'm going to go next and review 7 steps that will impact your financial life. Now, first is talk about money. I know that it's kind of tabooish. A lot of people don't like to talk about money with their family or their friends, and I get it. Sometimes it really can be uncomfortable. However, if you're not talking about money, how can you learn about it? How can you understand or see or get different perspectives and viewpoints of what people are doing and gaining success in it? Doesn't mean that you have to follow their exact path, but it could help provoke ideals that could help you find your situation to be much better than it currently is, or help you solidify that, hey, I think I'm actually on the right path. Now, one of the things that you've probably seen on social media or through articles, I like to say I'm the article king. I read all different kind of articles all the time. One of the numbers that's floating around right now is this number, $1.46 million dollars. Now, most Americans really do think that they need about $1.46 million dollars, and I'm not going to tell you that that's a bad number. It may or may not be your number. You may need more. You could potentially need, yes. It just depends on what your financial situation looks like. But if you look in the middle of this slide, you'll notice the age range. So the age range is from 35 to 74. But I want to drill down a little bit deeper. If you look at the two middle ages, the 45 to 54 and then 55 to 64, you'll notice that the cups there are pretty much equal. Maybe $1,000 difference between those two. Why is that? You may not have even thought about it. Maybe you have. The reason why that's like that and what we're seeing is that those age ranges are kind of in that sandwiched generation to some extent, meaning that you could easily be in your 45 to 50 for age range and having to take care of still young kids, or taking care, helping take care of kids that are just not in a financial situation to fully be financially free of you, still in our pockets as parents. But then you also have where you 55 to 64, where you may be helping take care of grandkids and your parents. Those age ranges of both could be either or. It just really depends on your situation. And therefore, a lot of times their income is being eroded from both ends. And they just doesn't have necessarily have enough disposable income to keep their savings going on a consistent basis. So that's something to put in perspective. You can start younger, it's better, but ideally always start where you are. Any questions about anything I said so far? Just wanted to ask. Now, next, you'll see there it says about 63% of people have a fear of running out of money. Now, I just recently helped a client move over some money into a financial product. And the first thing when I said with the client, when we went to talk about, what are the things that they have concern with, this was the first thing they said. They said, I plan to retire in 2 more years, and I want to make sure that my money does not run out. I want to make sure I have enough retirement income well into my retirement years. I was like, okay, wow. I said that's great. That's what we want people to be thinking about and concerned with. Additionally to that, her concern was I also want to make sure that I can receive the care in my home as long as possible. I don't want to have to go to a facility until I have to, if she ever has to. But she wanted to make sure that she had enough money that would allow her family to be able to take care of her in her home where she's most comfortable at. So we were able to look at her situation, come up with a solution, and put her in something that really made her feel a lot more comfortable, a lot less stressed than she had been feeling, and she'll be able to retire at the age of 62. And that's phenomenal. I'm hoping to retire at 62, even though I probably never retire. I just always be doing something. I got to keep the blood moving, right? Something else you need to really can think about and consider. Most of us have a 50% chance of living past 95. With the advancement in healthcare technology and pharmaceutical, it's a lot of ways that our life can be sustained. Now, that also means that if you retire somewhere in your 60s or earlier or later, you probably need to still be planning for anywhere between 20 to 30 years of retirement. So you're looking at about 3 decades of retirement time. What does that look like for you, right? Are you in a good place where you will be able to do that? And I also like to mention to people that a lot of times at our whatever your age is now or younger, we talk about quality of life. Oh, we want to have a great quality of life. We want to be able to do these things. I personally want my quality of life to also extend well into my latter years, right? It's something about being able to age in a way that you're comfortable and have a level of peace because you took the opportunity to try to put some things in place that allow you that. Because finances affects every part of our life. Next, we'll go in and we'll talk about wealth equivalency. And a lot of people may or may not be thinking about, well, what does that look like? Oops, sorry about that. When you think about wealth equivalency, it really comes down to thinking about how much money do you need? How much monthly income would you need? If you look at the table to the right here, it'll give you some idea. Monthly income, if needed $1,000, you need about $240,000 worth of savings that could generate that for you. Now, granted, everybody's situation is not going to be covered in a table like this. You may have some other assets. You may still have a pension. You may be one of the lucky few that still have a pension, or you worked in a profession such as being a firefighter or in the military that allows you to have a pension for the rest of your life. Hopefully, you've also qualified or will qualify for Social Security, whatever that may look like in the future. We all hear the headlines that it won't be around. Maybe it won't, but you don't want to be dependent on that if you can help it. Now, if you need $5,000 or $60,000 a year, you potentially need about $1.2 million. Again, don't take these numbers and start having heart palpitations and think, oh my God, I'm never going to get there. How am I going to be able to retire? What I'm hoping to do here is get you to open up your mind to think about, well, wait a minute, where am I at right now? What things do I have in place that would allow me to achieve this amount of savings or generate this amount of income? That's what this is about this morning. Two, know your financial situation. As business owners and or if you're a W-2 employee, tracking your expenses is one of the number one things that you have to do. You have to know as a business owner what is driving your expenses that's also affecting your bottom line. Your expenses could be the difference of one, retaining your associates and team members, bringing in additional team members, expanding your services from one location to multiple locations, adding a new service line so that you can expand, knowing your bank statements, understanding what's coming in, going out from that standpoint. Hey, why do I have this erroneous charge? Why did I get a bank fee that I shouldn't have? Insurance coverage. And when I say insurance, I'm not just talking about, life insurance or auto insurance, business insurance. But beyond business insurance, what about being a key business insurance? Think about it. If you're the business owner and you have the intellectual property and you started a business and the thing that you do is why this business exists and you do it the best than anybody can do. Yeah, you're training people and you're getting people up to speed. But what happens if for some reason there's a catastrophic event, such as a hurricane? We live in Florida. We live in Central Florida. We know that is a reality. Would you be able to, if something happened to you or that employee that is a key person, would your business be sustainable? Something to think about and consider. Your retirement investment account statements, you want to pay attention to that. Am I getting the growth that I'm expecting? Am I seeing a fee or charge that I don't understand? Have the conversation, make the phone calls. And of course, your loan and credit card statements. There's so much fraudulent activity that's out there. You want to keep an eye on this from your business side or your personal side to make sure what should be there is there. I always recommend using an accounting software. I know here in St. Cloud, we have different groups of accounting partners here that can help with that. I know personally I've used different ones over the years, and when it comes to tax time and looking from a monthly and quarterly basis, it really helps me zero in and drill down to what specific things are drivers in my business or in my personal expenses. Now, eliminate the unnecessary is number three. And you all seen this, get rid of streaming services that you're not using, late fees, credit card debts, and so forth. I'm not going to belabor that with you all. You all have heard that, you've read it, you've seen it. It's all over social media, and it's true. But I want to look at that lower right side, bad financial habits. Bad financial habits are what drives the other four, if you think about it. If your behavior or your bad habits are just that, then you probably are going to potentially have a higher level of credit card debt. You probably will have streaming services that you haven't looked at but once because it was this one movie that you wanted to watch 6 months ago and you haven't even gone back to the app again. Maybe you are going to swipe that card a little too much. Maybe you did write a check that you forgot because you never hardly write checks, whatever that may be. And of course, credit reporting errors. While that's not necessarily a bad habit, if you have the habit of not reviewing that, then that can definitely cost you, right? If you're going to go get a new auto loan, I know that's something I hope I don't have to do anytime soon, looking at what the current rates are, but they are pretty high right now. You don't want to have to pay 10% for an auto loan when you really should be getting 6 or 7%, all because you have a credit reporting error that shows you were 30 days late multiple times, or some credit card that's really not yours reporting that you're maxed out on it, or whatever that may be. Monthly spending habits, again, I'm not going to belabor this. Get your coffee, but instead of getting one a day, maybe you make it at home a couple of days out of the week. Maybe you treat yourself to it a couple of times a week versus 5 days out of the week, excluding Saturday and Sunday. I know people still do it sometimes 7 days a week. If you love events, fine, go to events. Never deprive yourself per se, but maybe you can't go to 10 events in 2 months. Maybe you only go to three or four. Just things to take in consideration. Review your subscription services. I'm not going to tell you not to play the lottery, but if you're trying to play the lottery in lieu of trying to put in the proper planning for for yourself, then I would say that the lottery is not the way to do it, right? That's a nice one. You know, if everybody's playing at work and you want to throw a buck in or $5 and you have the discretionary income to do that, go for it. Nobody want to be the last one left at work and everybody left. That's just a little plug there. Now, four, set your financial goals. Now, if you think about it, most business owners had a vision, and if they didn't necessarily have the vision, maybe their parents or grandparents, however they got in there and they got the vision, but somewhere in there they saw it too. They decided to go into the business with the family, or they decided to start their own vision because they saw something that they wanted to do, and they thought that they could do it maybe better than somebody else, or maybe they just figured out, wait a minute, there's a problem and I can solve it. You know, you got to really also decide, what is your financial outlook? What does it look like financially? You know, I think sometimes myself, when I look back when I was very young, I didn't necessarily have good vision of what I wanted that look like. I knew I wanted to have money, but why? Was it because I wanted to have a certain quality of life for my family? Was it because I really wanted to travel? Was it because I wanted the freedom of choice? And that's what I say, the freedom of choice to be able to move through life on your terms. That is a vision. Now, putting that vision together is not necessarily always easy, but identifying that and coming up with short-term, medium-term, and long-term goals is really important, because the short-term and the medium-term goals are really the building blocks to help you achieve that long-term. You know, 15 years may seem like it's a long way, but I came to Central Florida 14 years ago, and it feels like it was just a couple of years ago sometimes for me. So if you can take and put in perspective the things that would allow you to take step one, step two to step 100, you'll be in a better place, not just for yourself, but also for your business and for your personal life. So you gotta make a plan, right? If you make a plan, then you follow the plan. It doesn't mean that that's the only way you can go. You might have to pivot. You might have to change direction at different times, but it's really important to really find out what motivates you. You know, create that plan through the motivators that you have and look for the reason why you can do that thing. If you always keep looking for reasons why you can't, then guess what? You won't. You won't move forward. You won't get it. Just as a side story, right quick. I had wanted to move from my old career to this career full time a couple of years ago. And I was the last person that had to get convinced, meaning I had to convince myself, my family, my business partners, friends. It was like, man, what are you waiting for? Just go for it. Just do it. And when I thought about it, I went like, why? And so I took a moment and I stepped back and went like, this is what you have been working towards. You worked as a regular employee for almost 30 years. You started doing this because you wanted to better yourself and be able to help other people. So go for it. What do you got to lose? I didn't want to look back in 20 years and go, wow, why didn't I do that? Why didn't I try that? This is the thing that I work towards to build to be able to have that freedom to do that. Now, when it comes to budget and spending plan, it's really important to write it down. I use technology a whole lot, but you know what? I still use a pencil while it's mechanical and paper. I use it a lot to write down certain things because it's that tactile feedback that helps it lock it in into your memory, kind of like muscle memory. So I say write it down. That might not be where it stays. I wouldn't necessarily say leave it on paper, but maybe that's where you start as you work to strategize, as your mind is being expanded, and then you put it in your software. But a spending plan isn't really important. As you see here, it says it's about strategizing where your money is going in the future and to help you accomplish your purpose and your mission. A budget is really what? An estimate. And I know in business and personal, but in business, I'll use that more as an example. I know when I had other businesses, especially starting them off, you gotta know what you need. You gotta understand what you don't have and then how you're going to procure it. Now, when you're in that startup cost, it's usually a lot, depending on what that business is. But as times move on, you start getting enough data to have enough to make educated assumptions or estimates on what you may need in those different buckets. The thing that hurts most people is not understanding their budget and their expenses. If you can keep your expenses minimized, it allows you to be more open to be able to do more things. It allows you to take care of the people that you ask to trust you to come work for you. Now, we understand that there's external pressures that happen and occur that we cannot control, and sometimes things just happen, unfortunately, but not because you don't want it to be because you're not a good steward of your budget. Set it up automatically. I was talking to my dad the other day and he was in Georgia. And he's like, oh, I got to get back home. And I said, well, why? He's like, I got to go pay Home Depot. I'm like, Dad, really? G- You could pay that online. He said, I don't do technology, son. I said, okay, Dad. It could be automatic. Um, Now, creating an emergency fund. I know most people will look at this and think that this is just talking about from a personal standpoint. But this is not that. This is from both. This is personal and business. I'm really talking from two different points of views or perspective. Now, as a business owner, you may refer to it as how much cash on hand do I have? As a business owner, you want to be able to have enough cash on hand that if something were to happen, you can continue operations just as they are today. And could that be for 3 months? Is that for 6 months? Is that for a year? Everyone's situation is going to be different, but ideally, you want to have an emergency fund for that business for the event of those things that happen that you have no control over. Same thing from a personal standpoint. You'll notice there at the top is saying if you have an income of $50,000, you want to have about 12,500, or 6 months, you want to have 25,000. Now, again, everybody's situation may be a bit different. You may have lived a different lifestyle. Maybe you inherited your parents' home. It's already paid for. And so your monthly expenses are very minimalized. Well, then maybe that number looks different for you. I will say the more you have, the better you are. But ideally, you want to at least be able to cover the absolute necessities of what you need to cover until you maybe that bridge a gap or you finding a job or the business is able to get back up and running through some construction needs or whatever that event that may created a issue for you. A couple of rules you'll see at the bottom. It's really emergency fund. It's for the unexpected. Number two, use it. If a emergency issue comes up, use it. If you gotta buy, fix the car, buy a fridge, as it says down here, for example, go ahead and use it. It's not for you to hold on to it and don't use it. It's for you to use it for what you need and then replenish it. Just put it back. If you had to go buy a $500 or $1,000 refrigerator, probably more like $1,200, $1,500 now, then that's what you got to do. You got to eat. I don't know about you all, but I don't like keeping stuff in the cooler and having to keep putting ice on it. Um, Next, we're going to talk a little bit about taxes. I am not a tax professional, so I always urge everyone to talk with whoever you use for your accounting services or for your tax preparation. But I do want to kind of review just some things to think about. The impact of taxes during retirement, have to go to the government or things that you want to leave to your children. It's always a strategy to be able to do it to minimize the impact on yourself and for the future generations that you may be leaving these assets to. Now, in this example, you'll see where it says seed versus the harvest. Now, I think most people may be aware, maybe not. You really don't want to have to pay on the harvest. You rather pay on the seed because it's a lesser amount and let your harvest grow, and hopefully you'll be able to take the majority of that out without having to pay taxes. But that depends on what financial vehicle you have those dollars invested in. So you have tax now strategies, you have tax later, and tax. It says never, but it's more like tax advantage. Maybe not never. Example of some of those things you can see taxable accounts would be like a checking and savings account or a brokerage account that you have that is not in like a traditional IRA or a 401k. So if you had just like a Robinhood account or something, Schwab or somebody that you're using just to do your own kind of daily investing strategies, when you take that money out, those realized gains become taxable income. Qualified retirement accounts, those are deferred, right? Those are things that are taxed later. And that could be a 401k to 457 or a TSP, thrift savings plan, and also annuities. Now, how taxes affect the various savings and investment accounts are different. So the tax never that we have listed here, you got government bonds and Roth IRAs and then permanent life insurance. Well, with a Roth IRA, those monies are deposited in account after tax. So your paycheck is taxed. The money that hits your checking account is now available for you to spend or invest it how you like. If you send some of those funds to a Roth IRA later on when you go to retire, you can access those dollars and not have to pay taxes on them. Permanent life insurance also has a functionality where depends on how it's structured. You can build cash value within a permanent life insurance policy. And also, if it's structured properly, you can actually turn that on as income for yourself later as well, and you wouldn't have to pay taxes on it. That's a whole slew of things that you can do within that framework. Now, how much life insurance do you need? Rule of thumb says 10 times your annual family income. But let's think about this in the perspective of if I'm a 20 something year old and I have a 7 year old and a 5 year old, got a lot of years left that those kids are going to be dependent upon myself and my spouse or partner. And if something were to happen to me and my income of $50,000 is gone, what does that look like for my kids and the home that hopefully we've established? Would they be put in a situation where they wouldn't be able to maintain the very things that we was working for? So that's something to take in consideration. Now, if you're older and your kids are gone, they're self-sufficient, they're taking care of their things, your debts have been minimized, your home was paid for or almost paid for, then you probably don't need 10,000. I mean, sorry, 10 times your annual family income. Unless you're also thinking about building a legacy and creating generational wealth, that could definitely support that. Save and invest more money is number six. Now, this is a section we like to talk about time value of money. As you see listed here illustrated, this is a scenario where you're trying to have $1 million by the age of 67. Now, here, this assumes you're getting a 9% average annual return, which is actually can be achieved in the right solution. But if you look where it says the age of 20, you could put $113 up per month and look at that grow to $1 million, potentially more, depending on market fluctuations and everything. I think 1 million is pretty conservative. Again, depending on where you're saving those monies at. But if you double that and go to the age of 40, you see now you need to put up 6 times the amount. Now, I know if someone had showed me this when I was 20, I probably would have still been a knucklehead because I was only making $4.25 for minimum wage at the time, and I was a young parent. So I might have thought $113 was still a lot of money. But when I finished college and I got into my healthcare career, I was making a considerable amount more money before the age of 25. So I still had opportunity to only be in $100 and something dollar range to put up to save towards the future. Now, if you delay that even longer and you get to 60 and you go like, all right, I'm ready to plan now. Well, you potentially need $8,600 per month for 7 years in order to try to achieve that same $1 million. I'm not sure about you all. Um, we can't go back in time, but if I could, I'd definitely go back to at least 25, 20 preferably. Heck, even 15 when I got my first job. Maybe I would only had to put in $50. I don't know. But it's important to start wherever you are. Zoe. Now, Zoe is one of the characters in our books, and she talks about, the four disciplines and really just saying, whatever stage of life you're in, start it right now. Don't be deterred. Start right now. Now, looking at the four disciplines here, we talk about savings a little bit already. We talk about doing it automatically and regularly, and then being comfortable enough to know that you're going to have to make some adjustments and pivot. But this next concept, most people have never heard of. The rule of 72. I don't know if anybody on here has heard of rule of 72. If you want to throw your hands up or put an emoji up that say yay, nay, that's great. But most people have not. Now, what you're seeing in front of you is just a little short math shortcut to say that, hey, based on the interest rate that you have for an account that you're saving in, it tells you how long it takes for that dollar amount to double. Now, this is also assuming that you didn't put anything else addition. You didn't make any additional contributions. I don't know about you all, but I know I probably only got 172 in my whole, lifespan there. So I definitely want to get more than 1% interest on my money. Now, just to go a little bit deeper in this, this was a more drilled down view of that 72 divided by 1% to get you to 72 years to double. But take this in for instance. If you take what most people get from a checking and savings account, a regular, not a high yield savings account, just a checking and savings account, they're getting less than 1%. So say in this example, it's $1. It'll take you 480 years to get to two. But let's be a little bit more realistic, meaning you may inherit $5,000 from a great aunt. She passed away. She left you $5,000, and you said, you know what? I'm gonna sit this money aside, and I'm not gonna touch it. That's gonna be my emergency fund, and you let it sit there for the next 20 years. And you thinking one day, all right, I need to kind of touch that money. I hadn't really looked at it, but I know it had to grow. Well, guess what? It grew, but it didn't double. It didn't even reach a third of that value that you had in there additional. Now, I don't know about you all. None of us have 480 years. If you do, we can talk offline to understand how you're doing it. I'm not into vampirism, but if there's some other way that we can do it, please share. Now, most credit cards are 22% and higher. So think about that. The money that they're allowing us to use, they're making their money back in 3 years. Now, put your car interest rate in there. That'll also tell you how fast they're making money back on you. Now, if you go back to that initial example of the one in the 72 years, that just still seems crazy. But think about this. Right now, it's almost $12 trillion in regular savings account that's getting basically no amount of return on their investment. However, Our friends in the banks and credit unions, they are loaning that very money out at those higher interest rate, which is our money, and making a whole lot more than a trillion or 12 trillion in this case. So I just urge you that if you have your money sitting in a regular savings account, and I'm not saying you shouldn't have anything there because it's a reason why you may keep it there close to the touch to do some things. But the lion's share of your money should be in places that are actually going to help you make more money. Seven, learn how monies work. So really throwing back to the beginning of the presentation, um, as I wrap it up here, it's really take the opportunity, download one of these free books, ask me for a actual paper a version so I can bring it to you or mail it to you. Start your literacy wherever you are. If you already feel pretty literate, maybe it still help you go even further. Maybe it helps you help someone that's close to you in your business or your family. Additionally, we have a financial literacy quiz. This quiz is something that I share with clients and just people at large. It's a quiz that's not meant to make you feel bad or anything like that. It's really about being thought provoking to make you hopefully go, wow, man, I knew more than I thought I knew, or wait a minute, I didn't know anything. I didn't understand that. Well, I'm a resource. And if I'm not your resource, whoever you trust to help you with your financial situations, get with them. Have conversations about the question. Find out what you don't know. And how we do that through our 7 money milestones. We have 7 steps that we take, and everyone may not be in order depending on your situation, but number one is number one. Financial education is the most important out of all of it. Learn what you don't learn. Where then put your protection in place. Get your emergency fund built up. Reduce your debt, increase your cash flow. Maybe that does mean you need to get a gig job or a side hustle or something like that to bring more income. Because if you can reduce your debts, you have more disposable income. It allows you to get to step 6 to accelerate your wealth building because you have more income to do that. And then you want to also look at a way to fortify or protect your wealth. Make sure you have your estate plan together. I know some people would say, I don't have anything. Um, Everybody has something. I was in a training not too long ago, and the gentleman said that, hey, you don't have to estate plan. Everybody already has a trust in place. And of course, he was being sarcastic, right? He was being very sarcastic. And so he was like, yeah, everybody in every state has a trust and a trustee. And if you want to have the state be the one that's going to preside over the assets that you have built and determine who gets what and when, and by the way, give them a third of your estate to help figure it all out, then don't do anything about it. Also, healthcare situations, you want to make sure that you have people that can take care of the different things that may come up and decisions that have to be made. We also provide a fillable PDF where individuals or families or businesses can use this to fill out, where they are, what's their current income, what assets do they currently have. Again, it's kind of that pencil to paper situation, so you can print it out if you want, but you can also fill in on your computer. This discovery helps us understand what you have, what you may need, and then the paths that we should consider taking to get you there. I will stop here and say, hey, thank you so much, and ask if there are any questions or answers I can provide. You'll see my business partner, Mariko Walker. He's based in Jacksonville, and I'm here based in St. Cloud. Feel free to scan and meet with either one of us, or maybe sometime it'd be both of us. But again, thanks everybody so much for today.
Justin, what a great job. I don't think you can ever hear this too much. Some of us that have heard similar things, it just never, uh, you can't hear it too much. I know I've talked to some people, and it's surprising what train wrecks we make out of our business finances, our personal finances, and then we have regrets. So the message you send is just very timely.
Thank
Does
you. Thank
anyone
you.
have a question for Justin. Very good. Well, Justin, thank you for your time and thank you again for being a part of the Chamber family. We look forward to hearing more from you as the days go by. And thank you all for attending the Toolkit and this session on how money works. Everyone have a great day and a great weekend. Thank
Thank
you.
you, everyone.